Hello everybody and welcome to this new video entitled Undervalued AI Hardware Stocks, and I'm covering 8 stocks that I've updated in my spreadsheet. I have this large spreadsheet that I share with my Patreon members, and I kind of update the stocks with my usual valuation technique, and today I'm focusing on hardware. I've updated hardware for this video. AI hardware. Why do I invest in AI hardware? Because I think it's going to continue to be a mega trend in 2025. It is the picks and shovels approach. You're providing equipment that the software companies then use. They build on top of the equipment. But I believe it's easier to pick stocks earlier in the value chain than it is later on the value chain. The competition in the software space is intense, and the competition in the hardware space is intense too, but a little less. It's a little easier to see the winners. At least I hope that is the hope. That is the hope of these spreadsheets, and that is the hope of focusing on hardware. Hardware is used in similar ways throughout the industry. So this is a cursory look at valuations, and you're gonna hear me say the things that I've said a long time, which is let's get started with Nvidia. So Nvidia still looks cheap. When I look at the question, enterprise value over gross profit over revenue growth, how much am I paying for that forward growth? How much am I paying for that future growth? I'm paying a 0.44. That's in the lower half of my spreadsheet. That is not a high number in absolute. AMD is pretty high at a 1.4. It's the same as a big tech. Most of them have valuation the same as a big tech. Dell is a nosebleed valuation on EV over GP over RG, but under 0.5 for a leading company like Nvidia, that's pretty fascinating to me. Noteworthy that the analysts have updated their growth numbers up. It moved from 87% forward revenue growth next 12 months expected to 93%. And the profitability of Nvidia has not changed. Still extremely profitable, 76% gross margin, 64% EBITDA margin. Think about that. That's the advantage of being fabless, right? And it's Visa-like EBITDA margin here. Quite outstanding. And of course, when you add that growth and you add that EBITDA margin, what do you get? Well, you simply get the highest rule of 40 that I have in the spreadsheet of 200 plus stocks across various mega trends that I study on the channel. It's 157. Unbelievable, this rule of 40. It's I sold that stock too early for a profit. I sold it for a profit, but I sold it too early. Note also in this spreadsheet I have a productivity numbers. Typically for a modern day firm, for a 21st century company, I want the productivity to be above 1 million. What do I mean by above 1 million? I mean each employee has to answer for 1 million in revenue at least. And when you take the revenue of Nvidia and you divide it by the number of employees, you see a 3.8 million. So each employee at Nvidia is accounted for via 3.8 million. So this is a highly productive firm, pretty close to as productive as it gets, actually, if you look at my spreadsheet. Moving on to a company which unfortunately is not there in my view, and I still will analyze it for the channel. I know it's the chatter. Everybody talks about AMD right now, but the numbers don't look that good to me. I mean, just looking at the numbers, I'm not looking at the products. They're predicted to grow 11% over the next 12 months. The gross margin is not nearly as good as Nvidia. The EBITDA margin is not nearly as good as Nvidia. Yeah, the stock is twice as cheap on a price to sales-ish basis, but not on a price to gross profit, and not on an enterprise value over adjusted EBITDA. You know, kind of my PE, right? My PE is I use EBITDA as a proxy for cash flow. They're trading roughly in line, but with much lower growth, and they don't even break the rule of 40. And their EV over GP over RG is a 1.44, which is not very good. So unfortunately, on the numbers, AMD doesn't look that good, and you know, this likely has to do with the fact that Nvidia has more than a 90% market share when it comes to the GPUs, and AMD is playing catch up. They're the number 2 in that that industry. They're kind of the copycat, the more ugly copycat of the shining company in the sector. And of course, when I see Nvidia coming up this cheap in my spreadsheet, it is tough to justify owning AMD. I think a lot of people love AMD because AMD is down 10% over the past 52 weeks, right? Nvidia is up 194%, but Nvidia almost tripled over the past 52 weeks, not AMD, but there's a reason why. Nvidia is predicted to just about double their sales again in 2025. So that's the reason. And think about the operating leverage, right? If they double their sales again, what's going to happen to that EBITDA margin? Is it going to go even higher? Are we going to get a 70% EBITDA margin? Nvidia is just a cash cow. There's no other way to put it. I don't own any of these stocks. I used to own Nvidia. I sold it, unfortunately, way too early. Moving on to the stock that I own. I've covered it a good 5 times on the channel. Of course, I got in after all of the FUD regarding the accounting. The reason why I was buying through that FUD is because the CEO said numerous times that there was no restatement and there was no issues. And I believed in the CEO because of fiduciary duty of the CEO. So some of you may think that was foolish, but sometimes you gotta take a risk to get a deal, and I don't have a problem taking a risk to take a deal. This is what I did on this one. I'm happy to own it. The stock had sprung back past 40. Now it's back in the low 30s. I believe this stock is undervalued. Sure, there's still some shadow, some fear. Some people are still fearful about the NASDAQ removal and all that sort of stuff. But I do think a lot of the fear associated with the SMCI, they have to do with inertia, right? People don't update their frames of reference. There's still a lot of stigma associated with that stock. That's why it's so inexpensive. But look at how inexpensive this is. This is like HIMS cheap. This is HIMS territory cheap. We are at a 0.17. The stock is, let's call it, nearly a double rule of 40 at a 71 on the rule of 40 score. So how much am I paying for that growth? Next to nothing. Am I at the rule of 40? I'm almost double the rule of 40. Not to mention that, and you've probably seen this, SMCI, Verve, and Dell. These are the liquid cooling stories. Why do I put liquid cooling stocks into AI hardware stocks? That because Nvidia, you have Blackwell chip, is going to need to be liquid cooled. Sure, you can retrofit and use a fan, but most of them are going to be liquid cooled. And here you have the two leaders in liquid cooling, which are SMCI and Dell, and Verve has like a special chip cooling system. They're in the cooling business too, but slightly different. These three stocks are in the cooling sector, and the sell of their cooling equipment, of all of their cooling hardware, right, is going to be going up in line with the sale of Nvidia's Blackwell. You can't install Blackwell without the liquid cooling equipment. If you follow Elon Musk, if you follow XAI, you know the Nashville, was it Nashville? No, the Memphis. I think it was Memphis. The Memphis miracle that they did when they installed that giant supercluster of NVIDIA GPUs. Half of the cooling was from SMCI. The other half was from Dell. They seem to really be, kind of in a duopoly. Even though SMCI claims to have 75% market share in the data center liquid cooling business, the stock is so cheap. People associated with China, people associated with a lot of the FUD that had to do with the auditor resigning, but the books have been certified again. So to me, I'm good. I don't have a problem owning it. I understand why some people might want to stay out of it, but this one is just too cheap in my view. It's just too cheap to ignore, and that's why I own it. No financial advice. Moving on to Verve. A little bit of buzz on Verve, here and there. I don't get this valuation. I don't get why Verve has a buzz. It buzz over it. It doesn't achieve a rule of 40, although it's close, but it's expensive. EV over GP over RG is above a 1, and yes, they're in liquid cooling, but compared to SMCI, right? It's like they're 6 times more expensive than SMCI on a price to sales basis. Very very good 7-8 times on EV over GP over RG, and they're about half as good as SMCI. SMCI on Rule of 40, right? And sure, their EBITDA margin is a little higher and gross margin too, but the growth is not there. The growth is predicted to be 18%. So I don't really get this one. Maybe you do, and if you do, you can tell me more in the comment section, but I don't really get this one. Dell, let's talk about Dell. So Dell scores the worst on my spreadsheet on both EV over GP over RG and Rule of 40, and it's not quite as bad as Verve on productivity, but it scores pretty bad on productivity. So yeah, it's the old company. That's all I have to say about Dell. It's the old company predicted to grow at 1%. The problem is you may have a great solution in liquid cooling, but that's not going to move the needle when you have nearly 100 billion in revenue. Dell has become the sleepy giant, the quote-unquote blue chip. Although you may argue that there's a Dell discount, because the first time they went public, a lot of people got burnt. So you still have a Dell discount, but quite frankly, this is not enough to get me compelled to buy Dell. It's too old, too slow, too 20th century for me, and so I'm moving on to Micron. Micron is a tough one. It's the cyclical semi by excellence. I mean, this one is commented by money managers, hedge fund traders. It's commented over and over again. It's been treated as almost perpetually cheap sometimes. Some people say, "Oh, this one is always cheap." Now, I will point out that, and they mentioned it on the All In podcast, right? The number one business podcast out there. They mentioned Micron for their demand for their AI memory, high bandwidth memory that may be needed for the GPUs, for a lot of the GPUs of Nvidia. There's going to be a major need for memory, and Micron is a duopoly with another company. I can't remember the name of it, but the point is that the revenue growth on it is predicted outstanding, 42%. They're predicted to grow revenue at 42% over the next 12 months. Gross margin not that good. Adjusted EBITDA really good. And if you have EBITDA this high, right, compared to gross margin, what does that mean? And this is true for a lot of these semi companies, by the way. If you take a look, that means you get a lot of depreciation, right? Look at TSMC. TSMC is the same way. More EBITDA margin than gross margin. That means these companies must take some massive depreciation in my view. That's how I explain. Anyways, profitable company. Rule of 40 is at an 84. EV over GP over RG. How much am I paying for that growth? I'm paying a 0.28. That is not bad. That is cheap. That is in the green for me. Under 0.3. So all in all, I like this one. The problem is the past performance has not been very good. And if that's any indication, the question is this a cyclical play or a cyclical stock that one wants to get into? The numbers look good on Micron, and it may deserve a full analysis, maybe along with AMD or next to AMD. Now, moving on to Behemoth, which, as you know on this channel, I'm not gonna like those. It's TSMC and AVGO. It's just too big for me. You know, enterprise value over 800 billion. The revenue is 83 billion. The TSMC is essentially the leader. I mean, Samsung manufactures a little bit of semis, but TSMC is essentially the leader in its field. But because it's so big, because it has so much of a business, it's predicted to grow at 14% next 12 months. How are you going to beat inflation? You know, you're just catching up with inflation. So to me, it's a no-go. Gross margin is good at 54%. EBITDA margin is 68%. The productivity is okay, just over a million, 1.1 million. The rule of 40 is excellent at an 82. That's good. But how much am I paying for that growth? Yeah, I'm paying a 1.32, and that's because of a mix of a fairly high valuation, 8 times, let's call it 9 times sales, It's trading at 9 times sales and it's only growing at 14%. So that's why you get an enterprise value over gross profit over revenue of 1.32. That is not very good. It's too slow growth for me. Too slow growth to beat the denominator in my view. Too slow growth for this channel. But, a great base for an index fund, a great stock to put at the top of your index fund so that your index fund can be more stable. And probably that explains some of that. And the last company, I'm going to tell you the exact same thing as I told you about TSMC. It's too big. It's Broadcom. Broadcom just entered the $1 trillion club. Kudos to them. Their growth accelerated a little bit. They're now predicted to grow at 25%. They make a lot of the chips for a lot of giants here and there. They make the Google chips for AI, for example. The gross margin is 75% on Broadcom. So this is Nvidia-like. The EBITDA margin is very at 49%. Broadcom has a lot of Nvidia-like parameters. It's kind of the forgotten winner in the AI hardware space. Is Broadcom, is how I'm going to name it, the forgotten winner. And Hock Tan, the CEO, he's known to be a serial acquirer. It's tough. It's tough to be successful at acquisitions. Acquisitions very often fail, but for some reason Broadcom hasn't had a problem with acquisitions and doing accretive acquisitions. Note how they have a lot of debt, right? Almost $69 billion of debt. That's because of all of these acquisitions that they've been doing and tacking onto the business, adding to the business. But despite all of that, it's 16 times sales. Think about that. 16 times sales, 40 times adjusted EBITDA is what it's trading at. Productivity is good at 1.5 million, but the growth, despite these high prices, the growth is quote unquote only 25%, which means when my EV over GP over RG is above 1, which again is not enough to get me excited. Rule of 40 is great too at a 74. It's excellent. It's almost an 80. Rule of 40, it's excellent. Rule of 40 is excellent. Anyways, this is pretty much the video. As you can see, these stocks are profitable. This is clearly the era. But to me, the clear buy that I own right now, and no financial advice, but it's SMCI. That's what I have, and Nvidia and Micron also look compelling to me. But the main one, putting my money where my mouth is, the main one that I own and that I plan on keeping adding to is SMCI. That is the clear undervalued AI hardware stock in my opinion. This was not financial advice, not investment advice, just entertainment. Please like, please subscribe, follow me on X, follow me on Patreon. Thank you for watching and have a wonderful, wonderful day.